especially since they now have to start worrying about inflation protecting their portfolios. And they're never going to buy a lot of gold, but if they will go from the average of 0.5% in gold that institutions have today, they go to 1% or 1.5%. That's going to be massive gold demand that cannot be satisfied by the amount of physical gold available at today's prices.
So in that same article, Egon, you point to this bull market for gold continuing until at least 2026. So why is that the case?
Well, it's gold normally moves in roughly 10-year cycles, roughly I say, because it's and cycles can change. But if you just look at it in the last, of course, in the 70s, you take in the 70s, it moved from $35.71 to $850 in 1980. So that was more or less 10 years, and gold moved up to 25 times at that point, or 24 times. Then, of course, we basically had two down legs almost. We had almost a 20-year down to sideways market, and then 2000 started the next bull leg, and that's when we found that gold was unloved and undervalued, and we decided to go in and recommend also to the investors that followed us at the time and invested with us to gold, physical gold. So then so gold was down to 250. We bought at 300 in 2002, and then we had a 10-year period of gold going up in dollars to 2011, in euros it went up to 2012. And then actually, I showed in that article, my latest article, I showed an annual gold chart in dollars, where you actually annually, it's very interesting. You get a much more interesting picture and it shows you clearly that gold basically went up nonstop for 10 years without any major correction of any kind for 10 years. And then it went down 3 years, and that was it. So it was really only a 3-year fall, although it's felt a lot longer, because we think, especially in the dollar terms, if you take the extreme, which wasn't the annual close, of course, but take the extreme of $1,920, where gold closed, what the high was in 2011. Of course, we're still not above that. But if you then look at the annual chart, you take out the extremes, we are above that, number one. Number two, we are well above the 2011-12 highs in all other currencies, Canadian dollars, Australian dollars, in euros and pounds, etc. So it's just that we have seen temporarily a stronger dollar, which I don't think is going to last very long, but for the time being we have, and therefore, since most of the world wrongly measure the gold price only in dollars, because it's not, gold is set in every currency that people are based in. So it's just dollar-based investors that should look at it in dollars. Otherwise, if you're in Europe, you should look at it in euros or in pounds or whatever. And in all of those currencies, gold is doing very well now. So it's only a matter of time before the dollar comes down, and also gold in dollars will do very well. So coming back to your question, so we had a 10-year, more or less 10 years up to 2008, 11, 12, and then we had 3 years down. And then you take, so now we have roughly 4 or 5 years left of a 10-year cycle up. That's really my point. So therefore, it doesn't mean that this cycle can't extend, but I would say that 2025, 6, 7, that's the minimum period for which gold is likely to go up, but it can easily extend a lot further than that also. But certainly now, as I have shown in other charts, in relation to US money supply, gold is as unloved and undervalued today as it was in 71 at $35 and in 2000 at $300. So, gold is still today extremely cheap, and it's astonishing that very few people recognize this, and even more so institutional investors. They haven't started recognizing it yet, especially since they now have to start worrying about inflation protecting their portfolios. And they're never going to buy a lot of gold, but if they will go from the average of 0.5% in gold that institutions have today, they go to 1% or 1.5%. That's going to be massive gold demand that cannot be satisfied by the amount of physical gold available at today's prices. So that means that you can only find gold then at a lot higher price.
Egon, how do you look at the difference between gold and silver, and what are the roles of each in your portfolio?
From the beginning, when we started that at the beginning in 2002, basically what we recommend to people to buy gold, I think it was $300 then. We always said buy gold because if you want to sleep well at night, buy gold. Because for the average investor, silver is too volatile, and so if you want to sleep well at night, buy gold. If you want to have a little bit of fun and a bit of excitement and a few sleepless nights, silver, of course, will move 2 or 3 times as fast as gold. And therefore, on the upside, that is fantastic and everybody loves it. But the reason why we told people don't hold silver, except for at a very low percentage, is that, everybody enjoys the ride up, but everybody hates the corrections. And if you come in at the wrong time and go through one of these corrections in silver, they are horrible. And they're not for wealth preservation investors. Now, today, lately, we have been saying to people, yes, now, if you want to hold some silver, we think the opportunity is very good. We would not put a major part of your assets into silver, like we would tell people gold. That's fine if you do that. We think gold is you're going to be very safe with gold. But with silver, we say put a much smaller percentage into silver. But at now, the gold-silver ratio, the historical long-term average is 15 gold divided by silver 15 times. And now it's 80. It was up to 120 2-3 years ago. But now at 80, the gold-silver ratio being at 80, we think it's very, very cheap. So therefore, to put a much smaller percentage of your investment into physical precious metals, put that into silver, we think that's a good opportunity now. But at some point, whether that's when gold-silver ratio reaches 30, where it was a few years ago, or whether it comes down to 15 at some point, because of the volatility, it's always good to swap some of the silver when it really has moved up considerably. When it moved up, then you switch some of it to gold, in our view. Mm-hmm. So just to say, silver can be probably going to be a spectacular investment if you time it right and don't buy at the top, but buy now, for example, when it's low. Spectacular investment. It's not wealth preservation at all in the same way as gold is. So that's really what we're telling investors.
Mm-hmm.